Self-managed super funds versus your everyday managed fund by your employer. We're going to get into some real deep niches here in terms of what the difference in performances can be, what is a self-managed super fund. So if you want to find out more, make sure you stick around. Guys, welcome back. My name's Julian. I'm the head of strategy here at Ripehouse. And in today's video, we're going to be really getting into the kind of nitty gritty and comparing some models about the difference in performance versus investing in property through what's known as a self-managed super fund versus just the average performance of a managed fund. If you're new here to the channel, make sure if you haven't already, you smash that like button and subscribe because we're going to be releasing videos like this all the time in all aspects terming and property. So to get into today's video, firstly, what is SMSF or a self-managed super fund? So a self-managed super fund is essentially you taking control of where your super is being invested. So most everyday Aussies who are employed, you've got what's known as a managed fund. So your contributions from your super are automatically being distributed into a managed fund, and that's typically going to be in various types of assets. So it might be into projects, could be into shares, could be into cash reserves, could be into bonds, etc. It could be all different kinds of things. Whereas when you're getting into a self-managed super fund, that's essentially you taking control of where your money is allocated. Now, it doesn't mean though, however, you can go out there and start spending your money willy-nilly. It's a very, very heavily audited investment stream. So you need to make sure you're getting the right advice from, your financial planner, your accountants, your tax experts, etc. But it allows you to pick and choose where you can invest your money moving forward. And it's definitely something that has grown in popularity over the years. So as of March 2024, there's currently just over 600,000 people have invested into their super with over 1.1 million members, and it's currently got assets totaling over $3.9 trillion. So there's a lot of money being invested into super. So I guess understanding that how property investing is different in super versus your own name can be a really, really big one. So some of the differences of when you're going to go invest in property in your own name versus super. Some of the key differences are, so firstly, when you go and invest in property in your own name, your borrowing capacity is run off what your income is coming in from your employer, if you've got distributions coming in, whatever it may be, and all your liabilities are taken in. So if you've got HECS debt, car loans, credit card loans, mortgages, investment property loans, all your debts and expenses are taken into account to a serviceability. And the other kind of big key differences are if you've got a property in your own name outside of super, if it's grown in value, it's got equity in it, great. You can take some of that equity out, use it as another deposit, use that property to sell off for profit, use it to pay down mortgages, etc. You might go down value add strategy pathways where you do a subdivision, you do a really large scale renovation, you add a granny flat, all these kind of things which you can do in your own name. You unfortunately cannot do in super, but the big benefit that you get when you are investing in, say, something like property through super is that ability to get access to leverage. So for those of you who are maybe newer to the channel and unaware of what that leverage aspect is, maybe let's get into that just a little bit really quickly here on a quick slide. So if we talk about leverage, we have a quick look at the slide here. This is where your key differences come from, say, investing in property versus, say, shares or a managed fund. So if we look at example A, you start off with maybe $100,000 in capital. There's no leverage or debt taken on to increase the total value of that asset. So for really simplistic terms, we're going to use a 10% figure here. So you start off with $100,000. Your total investment is actually only $100,000. So if you get a 10% return, you're getting $10,000 in growth. So your total return on capital or return on investment is 10%. Now, where the acceleration of growth comes from when you're investing in something like property is that ability to leverage and increase your leverage position. Now, most people when they're investing in property, they're typically taking on an 80, 90, sometimes depending on the way they're structuring the loan, maybe even 100 or 105% loan. But for today's example, we'll use the 80% mark because most people, when you're going to go invest in super, they're probably going to go to a 70 to 80% leverage, sometimes maybe less. But it's that ability to increase the total asset value you have in your portfolio. So you might start with $100,000 and you take on then a $400,000 debt. So your total asset value there is $500,000. Now, if you're getting that 10% return rate on that $500,000 asset, you're getting a $50,000 return, which is a 50% return on your capital. So it's allowing you to accelerate your growth and returns. Now, I'm not saying it's going to be 5 times greater. That's definitely not the case, because there's other costs lying within that. But that's why property investing in general is always outperforming other investments, because it's that ability to scale up and get that leverage aspect working for you. So I think what would be handy, I've created a Excel document which I'm going to walk you through today. And the great news is, so if you click the link in this video later on, we're going to have a landing page for anybody watching the video. It's be no costs involved. You'll be able to download this Excel document yourself, and you can come in and make those numbers fit for purpose for you, and you can even break it and test it and see if it sits for you. But let's go through that in some details now, because I guess what we want to compare is, what is the difference of performance going to look like versus a managed fund versus property, and we can manipulate some rates, and we'll get into that as well. Okay, great. So now if we have a look here, so for you following along at home, the yellow cells are essentially all you need to change. Everything else is formula driven. And if we look here at the managed fund to begin with, so model number 1 at the top, if we're just the scenario we're running today is that somebody's starting off with $150,000 of a salary. Could be one person, could be husband and wife in this example here. But they're starting with $150,000 in funds. Now your contribution rate at the moment in Australia is 11.5% contribution coming from your employer. Now that's kind of creeping up at the moment. I think it goes up to 12% next year, and it's going to just keep going, and it'll hit the next barrier. And we're going to still get taxed. So that income is still taxed, but it's taxed in your super fund. It's taxed at 15%. So it's not taxed at your marginal tax rate. Super's a bit of a tax haven. Then we've got some average numbers here. So speaking with some financial advisors and accountants and just doing a bit of industry research, the average returns on your managed fund over the last little bit is about 7.61%. And then the other thing to keep in mind is that there are fees that happen in your super fund. So the average rate somewhere between about 1 to 2%. The numbers I've been given is about 1.52. I've also, again, increase some of the contribution levels here. So assuming that potentially it's going to go up to 12% next year, you may get pay increases as well. So there's an extra bit of contributions going up year by year as well. So if we have a look at here, year 1, we put our $150,000 in, we've got our contributions coming in, we've got some growth that occurs over that funds, we've still got our fees. So in year 1, we can see there's $2,693 in fees. That's where they get you and they make a lot of the money, because it's not just your fees. You've got to understand that there's thousands and thousands of people that are invested, but you get to $174,000 after the first year. Now, if we fast forward in the modeling here, we go to year 15, your starting position at then from the prior years at 760, your contributions are up to about $27,000 per annum at that point. You've got your growth, your fees at this point here, this is where they start to get you. They're taking out nearly $13,000 worth of fees, and your net position at that point will be at about $835,000. So you get to the point where 15 years on, your $150,000 has grown to $835,000. Keeping in mind a lot of that growth has also come from your contributions, but still, this is what you'll be taking into retirement. And I guess for most people, when you take into account inflation, that is potentially not going to be enough for your retirement. You might be still needing a portion of that to help you pay off your mortgage. So you need to just be asking yourself, what is your target? What do you need to get to retirement? What does your retirement look like as well? So that's model number 1. The second model is us buying a property through our super. So to go through that here, at the top here, this is the starting property price. So we purchased an asset, it's worth $525,000. And you can see in this cell down here, we're still left with just short of $20,000 left in the fund post that purchase. So again, we want to have the similar modeling. So we've got $150,000 of our starting base salary. We've got our contributions. You've also got the ability later on when you come in here, if you are making voluntary contributions, you can enter those numbers in here as well. Now we've factored in one thing to be aware of in super. Typically your interest rate is a little bit higher. So we've got it at a 7.5% number here. We've gone an 80% loan. We've factored in the growth rate, I guess, because this is for not what we achieve. We're achieving much higher number than that for our clients. But the long-term performance over the last 6 decades or so, a 3 or 4 bedroom home gets you around that kind of 7.3, 7.2% growth compounding per annum. So we've got 7.25 in there, got a gross yield of 5.2%. Property management fees are built in there. I've also tried to include cost increases. So, your costs aren't just a flat number. They are going to increase each year. Now, we hear the RBA, they want it to be within that 2 to 3% band. I've been a little bit more conservative here. We're going to go 3.5%. We've got rent increases and contribution increases in here at 4.5%. Again, rents typically increase at about a 5 to 5.5 number. Again, more conservative numbers. The more conservative, the better. And then we've got some costs in here. So this is breaking down, we want to factor in our council rates, our water rates, insurances, maintenance. We've got property management fees in there, and then it's taking into account your rental income, your super income, and also auditing fees. So you are going to need to get your self-managed super fund audited each year by an accountant or financial planner. So I wanted to increase all the running costs associated. Now in this modeling, we've just ran it on interest only. You do have the ability to do that. Not all lenders will offer that to you as well, but I think it depends on. Again, this is not bespoke to an individual. We're running it into just a dummy case here. But for most people, if you want to not be committed to that principal payment, you are going to take on higher rates. You might also get the benefit of, if you've got leftover funds in your super and there's more contributions building up, maybe you've still got an extra 10, 20,000 going in there because there's two of you. You might get to the point in 4, 5, 6 years later that there's an extra lump of cash in your managed fund. You might want to use that to buy another property. You might want to diversify into other assets. So again, that's going to be a chat to have with your financial advisor at the time. But if we look here and we compare the years here, at year 1, we can see basically the value of the fund in total, because we're taking into account the property value. We're taking out into all costs. So gross income, gross outgoings, interest saved, because we've got portions of that money going into an offset facility, offsetting some of that interest, so we start to save some money across the years. And if by the time we get to year 15, we've got about $1.7 million worth of the property value plus the funds. Now, obviously, if we want to get to the point where we can access those funds later on and use it, we're going to have to sell that property. We're going to then have to pay off the debt on that mortgage if we've only just paid interest only. So we get into the position 15 years later where we've got about $1.25 million. Now, if we compare performance over that period of time, we can see the managed fund got to a point where there was $835,000. The self-managed super fund with property in it got to $1.25 million. So there was a difference of over $400,000. So the actual difference as a percentage was a 50% difference. So that can have an enormous impact. We've done some conservative figures in here. Now we could make the argument, well, we want to get into a higher performing asset. Maybe we want to be averaging around 8.5% over that period of time. Potentially we feel that those interest rates are going to kind of, we'll just call it, stabilize over that period. Maybe they run at 6.75, and you'll see there's quite a huge difference. You may be potentially getting close to doubling the performance of your managed fund over that period of time. And if we reverse engineer that and go, well, they stay exactly how it is in your self-managed super fund property, what percentage does your super fund need to get to actually get on par with your self-managed super fund in property? I actually haven't run the numbers on this, so we'll bump it straight up to 9. Let's see where we get. So we're still 30% off the mark. Maybe we get to 10.5. We're still about 10% off the mark. And we'll probably need to get to about 11.25. So it's about that 11.25, 11.5% number, which if you're somebody who takes real detail and analysis on super, there aren't too many managed funds out there. If they're getting a double-digit return, they're normally giving themselves a big pat on the back in that year where it does happen. So that's not something that's going to be happening at a rate year after year for 15 years. So me personally, I'm a huge fan of self-managed super funds, particularly in the property space. Even if I was to diversify out, I would probably look to buy some other assets. I like the aspect of leverage and control, but it really is something that you need to get bespoke financial advice on from your financial planner, your accountant, or whoever your advisor is in that space. If you have any questions on property related questions about buying property in super, we can absolutely help you with those questions. Make sure you click the link below, have a conversation with myself or the team. But again, setting up the super fund, you want to speak to your financial planner. Guys, if you like today's video, make sure you hit that like button and subscribe. And would love to know your thoughts on what your feelings are. Are you already invested in super? Are you considering it? Leave a comment below. Maybe you think I'm an idiot rambling on. That's okay. Leave your comment with feedback. We'd love to know more. So thanks for watching, and we'll catch you on the next one. Bye for now.